Hello, it's Jeffrey Christian of CPM Group. It's about 10:15, 10:20 in the morning on Friday, the 19th of September here in New York. We've seen the FOMC reduce interest rates this week, and I want to talk a little bit about interest rates and what they mean to precious metals prices, but let's talk about precious metals prices too. As the Fed has lowered interest rates by 25 basis points, the gold price has moved to a new high. It broke above $3,700 an ounce over the last day or two. It's come off a little bit this morning and really yesterday, actually. And as around 9:30, it was trading around $3,679. Our expectation is that the price will continue to rise higher over the course of the next several months and possibly even through most of 2026. That's going to depend on the economic and political environment. And quite frankly, the political and economic environments look like they're going to be much more hostile over the next year or more, longer, which is probably going to propel gold prices to new records. I believe our expectation is that the price will probably be trading around $4,000 by the end of this year, which is less than 3.5 months away. You can see from this chart that the price has risen very sharply since the middle of August, or actually late August. It started rising around the time of the Kansas City Fed's Jackson Hole, Wyoming conference. That puts the price in a situation where it could come off. Our expectation is that the economic and political anxieties that investors feel are great enough that what we've done is, in our most recent gold trade recommendation, which was yesterday, we said that we put a stop loss at $3,650, thinking that the price could spike lower, but maybe won't spike lower than $3,650. So that's not too far from where we are right now. It's probably about $80 lower than where it was when we made that recommendation to our clients. But you can see that if the price were to break below that level, you could easily give up $150 and take it back down to $3,500. There are people who would argue that over the next several months, the price could fall as low as $3,000, $3,300. We point out that has that the gold price would still be pretty much at record levels. It would be higher than it was at any given point since late March, early April of this year. But our expectation is that given the level of anxieties that investors around the world are seeing, you're not going to see prices fall that far. Our expectation is that the price will continue to show strength again through the fourth quarter of this year and probably most of 2026. Silver prices also have been rising. They've actually shown interesting amount of support around and above $42 an ounce. Trading either side of the $42 an ounce. This morning it was around $42.30. Again, strong investment demand. One of the factors that has always been important for silver is the trends in investor selling of silver. If you go back to 1973, 75, there was a lot of investment demand, pushed the price up from very low, like around $1 to around $5. Over the ensuing years, 1975 through 1978, the silver price trended lower and investors were disenchanted. They had thought that the price would continue to rise in 1975. It didn't, and there was investor selling. Over the course of 78 and 79, you saw investors selling on a gross level dissipate. And investors started thinking, well, if I don't sell today, if I wait till tomorrow, I might get a higher price. And the price was higher the next day. And they said, well, let me wait another day. And as that progressed, you saw less gross selling by disenchanted investors, and then they became buyers again, and then they were joined by other generalist investors in the actually the final 4 months of 1979, when the price went from a very low price up to $50 in January of 1980. So one of the leading indicators was a decline in the amount of gross sales by disenchanted investors. You saw a similar situation in the early aughties, really starting around 1997, 1998, and progressing into 2002, where investors were selling less silver, disenchanted that the price had gone to $50 and hadn't stayed and moved higher. Investors sold a couple billion ounces of silver over the course of 1990 into 2005, but the pace of sales from investors declined sharply starting around 1988, 1999, and progressing into 2005. And that was the leading indicator of rising silver prices. Silver prices broke above $5 in 2005 or so, and rose to $50 in 2011. So we pay attention to the rate of sales, gross sales by disenchanted investors as a leading indicator of rising prices. Over the last few years, you've seen, really 23, and then especially in 2024, you saw a lot of disenchanted investors selling silver at $28, $30, $32 an ounce. We've seen a dissipation in that gross sales rate really over the last few months only. And that, again, may be a leading indicator of a sharper upward move in silver prices on a cyclical spiking basis. There's also been some talk in the market about silver lease rates being high. There's a lot of misunderstanding, it seems, about that. And I hope to cover that in next Tuesday's video, unless something more interesting intervenes. Platinum prices spiked up again. They got over $1,450. They've been trading as of this morning. They were $1,386 an ounce. These are very important levels because if you look at the long-term investment, the pattern of investment in platinum, there was not a lot of investing in the 1990s. From 2000 to 2007, there was a lot, several million ounces of platinum were purchased, a lot of it by hedge funds and also hedge fund managers for their own personal accounts. After 2007, really beginning in the first quarter of 2008, when there was a power outage in South Africa, which disrupted platinum production and price spiked up to about $2,200 or so. And then the power came back on and we went into a recession, and the auto industry was selling platinum inventories instead of buying platinum to put into cars because the car sales had declined so sharply during the Great Recession. Investors got disenchanted. And starting in the final quarter of 2011 and then progressing through 12 and 13 into the first half of 2014, investors were selling several million ounces of platinum. They still held a lot. And when a 6-month strike in the South African platinum industry occurred in the first half of 2014, and the price didn't rise in reaction to it, it was sort of flatlining, investors said, well, what happens when the strike settles? And what happened was the price went from $1,600 to $1,400 to $800 an ounce in about 6 months. Investors stopped selling their physical platinum. They hedged what they still had, which was several million ounces. They hedged what they had by going short the NYMEX, and you saw a big surge in non-commercial short positions on the NYMEX platinum exchange second half of 2014 and 2015. And then the price basically flatlined between $800 and $1,100 for most of the next period of time, 2015, until June of this year. prices have spiked up. And those investors who had stopped selling when the price fell below 1,400 started saying, well, let's see where the price of platinum goes next and why. Why did the platinum price rise from $1,100 or $1,000 in May to $1,500 in July? Because there might be a new bullish story in platinum, or maybe it's just a speculative thing. Do I resume sales, or do I buy more, or do I hold what I've got and I'm just happy that the price is finally recovering? Also understand, a lot of the platinum that was purchased in the period 2000 to 2007 was purchased at prices below $1,500. So these folks still have some profit in their platinum positions that they've held for 20 years now. But that's where we are, and that's what we're watching for platinum. Palladium's a little different. You saw a lot of palladium being purchased over the last decade. Prices spiked higher in 2021 when Russia invaded Ukraine in early 2022. The price spiked very high. It came off very quickly. It came back to where it had been at the end of 2021. And then it drifted lower over the course of 2023. By late 2023, the price was basically trading between $800, $900 on the bottom and $1,100, which spikes up to $1,200 on the upside. Again, in June, the price of palladium started spiking higher. Seems to have had to do with some inventory building and some speculative demand and speculative buying. Price spiked up, got almost to 1,400, came back off to around 1,100, and now it's, as of today, $1,179 an ounce. And again, investors are saying, okay, was this a speculative spike similar to the ones that we saw in late 2023 and in the middle of, I guess it was the fourth quarter of 2024? Is this another speculative spike? Does it come back down to that $900, $1,100 range? Or is there something new fundamentally changed? Our expectation is that it's the former, not the latter, and the price will drift lower over the next period of time. But with gold and silver prices likely to stay strong because of investment demand based on economic and political concerns, and our expectation that the economy is going to deteriorate shortly over the next really couple of years, platinum and palladium prices may be held up by the stronger gold and silver prices, even as they're pulled down by lower fabrication demand and lower auto production and sales. So, interesting time to watch these metals. Let's talk about interest rates. I saw a version of this chart in several media reports about the fact that the Fed had cut interest rates this week. And, the image is that interest rates have shot up, really starting in 2022, but now they're starting to come down, but they're still at very high levels. This is a chart back to 2010. This is a more informative historical view, and you can see that even at their peak last year before the Fed started to cut interest rates, even at that level, interest rates, short-term interest rates, this is the Fed funds rate, were lower than they had been for most of the period of time, really going back to the mid-1970s. So while interest rates are high compared to the zero interest rate policies that the Fed and other central banks pursued after the global financial crisis and Great Recession, they're actually low by historical standards. So there's a lot you have to unpack to really understand what matters between interest rates and gold and silver prices and between interest rates and the overall economy. There are people who don't appreciate historical perspectives, who say nothing before 2008 matters. We disagree. And one of the things that we always tell people is it's important to look at interest rate levels and rates and changes, but it's the rate levels and the rates of change that you have to keep in mind why it's happening. One of the big things, here's a chart, and this only goes through 2021. I actually was looking for a different chart this morning, and I found a couple charts that we did in late 2021, and I thought they were useful. So this, only has gold rising to a record $2,000 an ounce in late 2021. But this shows you the relationship on a very broad, simplistic basis between gold prices and interest rates. Now, a lot of people will focus on the decline in interest rates from 1982, 1985 onward, as gold prices moved sideways for most of that period of time, from 1982 to 2002, moved sideways and actually fell in line with interest rates from 1995 through 1997. And they'll look at the broad decline in interest rates and the broad rise after 2002, 2001 in gold prices and say, well, okay, lower interest rates are good, tend to relate to higher gold prices. And simplistically, there's some truth there. Lower interest rates do a lot of things in the economy. One of the things it does is it reduces the opportunity cost of holding gold, because you're not going to be getting, if you look at here, late 80s, you had 21% interest rates. You're not getting 21% interest rates. The late 80s, under George H. Bush, you were down. You were in that 6 to 10% interest rate levels, and then it got progressively lower. So you lose the opportunity cost of owning gold. Lower interest rates also tend to be reflective of lower economic activity. There's less demand for credit and to borrow money to build things, and that tends to cause investors to be a little bit nervous about the state of the economy, and they buy gold. But it's sometimes interest rates and gold prices are reacting to the same thing, and it's not that gold prices are reacting to interest rates, but they're reacting to the same thing. And so you have to unbundle this, and you have to really understand it. And I'll show you a couple more slides about this. It's really important to understand why interest rates are rising or falling, because different reasons pushing interest rates lower at this time have different implications for gold prices. And you see that if you go back and you look at this. Interest rates and gold prices rose together 1973 to 1975. That was because that was a period of high inflation and economic problems going into a recession. Interest rates and gold prices fell 1975 into 1977 because we were in a period of time where economic risks had declined. Interest rates and gold prices rose from 1977 into 1980 together. And then they declined from 1980 into around 1985. So they don't move in opposite direction all the time. And what you have to understand is, why are interest rates moving up or down? And what does that mean for gold prices? Because the world's a lot more complex than some people would like you to believe. Again, one of the things that's very important is to look at the rate of change in the percentage change in interest rates and the percentage change in gold prices. Then you're looking at apples to apples. Some people will take the interest rate and the gold price. So you've got the cost of gold, and you've got the cost of money, and they'll do a simple correlation and say, oh my God, there's like 50% or 70% or 40% correlation between interest rates and gold prices. But if you're comparing apples and oranges, if you look at an interest rate percentage and a gold price in dollars, if you convert it both to interest rate changes in the percent changes in the assets, money and gold, you get a much lower correlation. And that's important because now you're measuring apples to apples and not apples to oranges. And if you put that together, this is the title shot. What really matters. The correlation between gold changes in real interest rates and changes in gold prices. This chart's from our Gold Gear Book 2025. Anybody who wants it and wants to see it up close and read about it and study it. The correlation is negative 16%. And you can see this is a scatter plot. The upper right-hand corner is when real interest rates and real gold prices are rising. The lower left-hand corner is when they're both falling. And then the other two quadrants are when one, in the upper left-hand side, that's when real interest rates are rising, but gold prices are falling. And the lower right-hand side is when real interest rates are falling and gold prices are rising, I think. Anyway, you've got a 16% correlation. 84% of the time, if you think that gold only moves opposite direction to interest rates, you're wrong. So it's really important to understand why interest rates are moving. It's not that we're in a recession. We actually have pretty strong economic activity right now, but the signs are starting to appear that period of better economic activity could disappear quickly, and you could see a period of time in which you're in a recession or you have much lower growth and the demand for credit is much lower. And the supply of credit is much higher because right now we have more investable funds in cash, bank CDs, treasuries, short-term interest-bearing assets. We have more money and a higher percentage of investable funds in cash looking for good investments than ever before. That's another warning sign that investors are not finding things that they're really attractive to. The stock market's at record levels. That causes a lot of nervousness for people who have done very well in the stock market. They say, okay, maybe I take some profits in my stocks, but where am I going to put it? So they're holding it in cash right now, getting shorter term interest rates. That's all I have for now. I'll be back next week. And in the meantime, you can go to our website. You can buy our yearbooks or subscribe to our monthly precious metals advisory or our monthly base metals advisory. Read about all the things that other services we offer. And you can send us a note at info@cpmgroup.com. In the meantime, take care of yourself. Take care of those around you. Try to do something good for the world this weekend. And we'll be talking to you next Tuesday.